Hi, and welcome to another episode of Your Future, Your Finances. I'm your host, Brian Kuhn. Here we interview a variety of experts on the topics of personal finance, personal growth, and current events here in Maryland and nationally. In this segment, we will be talking about a topic that affects practically everyone, which is taxes. We had a major piece of legislation come through, and here to talk about it today are Kathy Grice, CPA, who's partner at Bormel, Grice and Huyett, and Barry Field, CPA manager, also at Bormel, Grice and Huyett, right here in Laurel. Welcome to the show.
Thank you, Brian. We want to thank you for letting us be on your show. We greatly appreciate it. One of the things that we're going to talk about are the some of the new things that have happened. There's been a lot in the news. Some of it you heard a lot about the proposals, and we're going to tell you a little bit about what has actually been passed. And one of the things that will affect everybody, and since most people have already filed their 2017 tax returns, they probably have turned their attention towards planning their 2018 taxes.
Yeah.
Or maybe not, we'll see.
So with this piece of legislation, what are some of the highlights that came through?
One of the highlights is that most everybody, the rates will be a little bit lower for everyone. So that's one of the things that they'll see. The other thing that has come out is that for most people, we have this. Most people they are either itemized filers or they file with a standard deduction. But most people we're going to see now in the future that they're going to change from being itemized filers to standard deductions. And the reason for that is that the standard deduction for everybody is pretty much doubled. So if you were double before, as far as two spouses, you would have you would now go from having $12,000 as your standard deduction. You are now going to be $24,000. So that's quite an increase, and that's why we say that most people are now going to be filing with a standard deduction rather than the itemized deductions. The other thing that has happened is that a lot of people used to say that they got killed with the alternative minimum tax, and a lot of people are now not going to be in alternative minimum tax because the rates have changed in the alternative minimum tax area also.
Good.
The other thing that people want to be aware of is that the individual tax area, the new tax law, what they might not realize is that it's only going to be in play for a little bit. When I say a little bit, in 2025, a lot of the individual tax laws are going to sunset. My co-worker here, Barry, is going to tell you about some of the other changes that have happened with the new tax law.
Thank you, Kathy, and thank you for having us, Brian. As Kathy was alluding to earlier with itemized versus standard deduction, for folks that itemize, they can continue to itemize and deduct their state and local real estate taxes, except that's been curtailed significantly, that you can take a combined deduction for Maryland income taxes and real estate taxes of a total of $10,000. If you're a single taxpayer or married filing joint, it's the same $10,000 ceiling. Another area that's continuing on is the mortgage interest deduction. There was talk about eliminating the deduction, but they kept it, except they lowered the amount that the debt can charge interest on from $1 million to $750,000. So folks who had $1 million mortgage or less, prior to December 15th, it's an odd date, December 15th, 2017, if you had $1 million mortgage or less, you can deduct the full interest every year. So with that, starting from that date forward, new mortgages over $750,000, you have a limit of the interest is limited. One thing to note is anyone with a higher mortgage who refinances, you can continue at that level. But if you have a house with that higher level and you sell your home and move, you're back to the $750 limit.
Interesting. Kathy, do you think there are some clear actions that people can take now that this law is passed?
One of the things that they want to make sure that they do, looking forward to 2018 and beyond, is some of the clear actions they can take is you want to make sure that you pay attention to the withholding tables. They're not going to really work out for everybody, so you may want to consult your tax advisor and do a projection for the new year. And the reason that I say that is you have to remember that the projections, the withholding tables, are only set up for one person in the household working, not for both spouses working. So they only take that into account. So you have to be very careful with that.
And Barry, both of you have mentioned the standard deduction versus itemized deduction. For anyone watching who's not familiar with those terms, what's the difference between those two?
Yeah, thanks. That's a good question. The simplicity is really the best answer. For folks who take the standard deduction, forget about the old limits. Single taxpayers, it's $12,000 now. Married filing joint, it's $24,000. No questions asked, you get that. Even if you don't have deductions up to that amount, you get that deduction. Between your real estate taxes, between your state and local taxes of $10,000, charitable contributions, and mortgage interest that we discussed moments ago, and also if you qualify for medical, if those all add up to more than $12,000 for a single person, or more than $24,000 for married filing joint, then you would want to itemize, and you get the higher amount.
Okay. And also, Barry, it appeared that there was things that would affect specific Marylanders, like the state and local tax. Is that
Yes.
right?
A couple things there. On the state and local, Maryland tends to be a higher tax state. And so a lot of people, and we were all reading about this, the cap of $10,000 for state and local state income taxes and real estate taxes could affect a lot of Marylanders who would otherwise be taking a higher than $24,000 standard deduction. If they can take more, are now going to take the standard deduction at 24 because they're not going to be able to exceed that without the higher tax. So when we hear all about these tax increases, that's a deduction that folks in Maryland are not going to get. Another area where they can see where there's a little discrepancy at the state level, this gets a little bit complicated. If you itemize for your federal tax return, you must itemize on your Maryland tax return. If you take the standard deduction for federal, you must take the standard deduction for Maryland. And the standard deduction for Maryland is much lower than it is for the federal on your federal tax return. So what's happening to folks is they're going to see maybe tax decreases potentially at the federal level, but because they're no longer itemizing and they're taking the much lower Maryland standard deduction, they're going to see possibly a tax increase at the state level.
Speaking of that, do you think there are scenarios where people will actually have their taxes go up?
We've done some calculations, and not talking about the standard and itemized deduction at the state level, but at the federal level, one thing we've concluded is folks, retirees on a fixed income, if most of the tax rates that have come down, the brackets have also spread out. So you're in a bracket for a longer period of time. And folks at the lower brackets, the middle brackets, say if you're making about a married filing joint couple, $150,000 to $250,000, which sounds like a large number, but that's very common here in Maryland. They're in these lower brackets they're not in the brackets as long as possible. And with the changes of the itemized deductions, they'll take the standard deduction of 24, where they might have taken a larger deduction. And on a fixed income, every dollar counts. So if they're losing a few deductions, suddenly what their budget has changed.
Yeah. Now, Kathy, shortly after it was passed, the Treasury Department announced these withholding tables, meaning the paychecks, I guess, are supposed to go up. Can people rely on that or understand what that means for how that affects their taxes?
They shouldn't rely on that solely because if their paycheck, they may get more money in their, their weekly or, biweekly pay, but they have to make sure that they coordinate that with their spouse. And they also need to be careful. Some people work more than one job. Some people get commissions. Some people get bonuses from time to time. And when you rely solely on the tables assume that you get the same pay all the time, every time, throughout the whole year. And that at times could cause you to, possibly not withhold enough funds. And that can become problematic when you go to file your tax return. You might not have enough tax withheld, particularly in those instances where you're getting commission or you're getting bonuses, because it assumes that you're getting a different pay. It also always assumes that there's only one person in the household working, and if you file a joint return, therein lies the problem.
Right, absolutely. Also, Kathy, they changed the estate tax rules, is that correct?
They did change the estate tax rules. For most of us now, with the estate tax rules, most of us won't have to worry about a federal estate tax issue because the estate tax went from $5 million obviously to 10 million. So that's quite a bit for most of us, and our states wouldn't be that large. The other change would be, and it's just a slight change, would be if you want to gift away part of your assets now, the gift tax rule, it went from $14,000 to $15,000. And what that means is that if you wanted to gift away some of your assets, you could do that tax-free. That's not a deduction or anything. It just means that you could gift away $15,000 of your assets tax-free without paying any gift tax.
How about here in Annapolis? Did they pass anything on the state level that affects filers?
They did pass some things that relate to filers, and as Barry alluded and mentioned earlier, we do have some things that they did. Maryland is one of those states that we call it couples with the federal return. So whatever you do with your federal return, Maryland also does with your state return, and they changed their standard deduction just slightly to try and help out. But in the long run, most people are going to pay a little bit more Maryland individual tax.
Okay. Barry, they also did something with lines of credit, right? They made a change there regarding the deductibility.
Yeah, folks have to be real careful with what everyone's saying is they've eliminated the deduction on lines of credit, home equity lines of credit, and that's a harsh way to put it. They've changed the rules for home equity lines of credit. The old rules were if you had a home equity line of credit of up to $100,000, no questions asked, do whatever you want with that money, and the interest was deductible on a line of credit up to $100,000. The new rule is what they've changed, as long as that money is used for significant improvements to your home, then you can still deduct the interest. One of the keys, though, is that that line of credit must be secured by that home. You can have a primary home and a second home. You can't get a line of credit on one home and use the proceeds to rehab your vacation home and vice versa. And what's going to come as a surprise to some folks is people who have that an existing line of credit, if they use that money for medical purposes, if they use that money for education, to buy a car, to pay credit card debt, there is no grandfathering, unlike the $1 million or $750,000 on the mortgage, that if you use that line of credit for personal purposes, that interest is no longer deductible.
Now, for just someone's 2017 taxes, since tax season has just wound down here in early May, if somebody realizes that they have about to submit their return and they don't have the money, if they owe the IRS, what do they do? What are the action steps?
Yeah, a couple things. Ultimately, it's going to get to what's called an installment plan. But before you get to that, the first thing is file your tax return. A lot of folks tend to hide from the problem and think it's going to go away. If you owe taxes, you need to at least file your tax return and let the IRS know that you owe the taxes. Maryland as well. If you owe under $50,000 to the IRS, the process is very simple. You can literally call the IRS yourself or even fill out a form with your tax return as you file it. And generally, they'll give you 60 months, 5 years, or even 72 months, 6 years, to pay it off. So you look at the amount you owe, divide it by 60, divide it by 72, add a little bit more for interest, and they'll very quickly enter an installment plan with you. If you owe more than 50, it gets a little more complicated with filing financial statements to get approval of the amount, of the monthly amount. One thing we also like to tell everybody is the Maryland rate is much higher. The penalty and interest rate is much higher than the federal tax interest and penalty rate. So if you can only pay one, actually pay your state taxes first and enter an installment plan with the IRS. The other thing is do not take out, if possible, do not put the balance on a credit card, because your credit card balance, your rate is going to be much higher than the IRS. Just call the IRS, call your tax preparer, and it can be taken care of very easily.
Okay. Now let's switch gears for business owners or business taxes. There were some changes to that legislation as well. If someone's watching this is a business owner in Maryland. How has the legislation affected them?
Well, we had a lot of new changes with that also, but one of the easiest changes that people are going to remember from what they heard in the news is that for the corporations, they're going to think tax rates are lower. It's a little bit more simplified. If you're what we call a C corporation, it's 21%. The other thing that they're going to remember, and that's down from 35%.
Big drop.
So that's a big drop, and that's was supposedly done to spur the economy. But there are several other forms of business. There's S corps, there's LLCs, which could possibly be an S corp. They can also be partnerships. They can be sole proprietorships. So there are other forms of business. And depending on what form of business you are, and if you qualify, you can get a 20% deduction to lower your taxes if you fit in certain categories. But you should definitely consult your tax advisor for that. So that's one thing that that's a definite change that will lower your rates. Some other changes that have really happened in the business area is in the area of business and entertainment, because a lot of people normally thought, oh, well, I'll take my business associate who feeds me a lot of business out to play golf. Well, that is no longer deductible.
Okay.
Let's say I take them out to the ballpark and I buy tickets for the ball game. Those items are no longer deductible at all. What is allowed now is if you have an employee party, say a holiday party, those are still, and if it's for the benefit of your what I call your employees and not for the just the owners, then that is still 100% deductible. So that still will work. But you have to be very careful now. If you are, none of the entertainment things such as sporting events and that sort of thing, if it's, to take a business associate out, those are no longer deductible. So I would say you need to check with your tax advisor. But the thing that has not changed is the documentation. You need to still document the who, what, where, when, and why. So that hasn't changed at all. And then the other thing that that when we mentioned in the individual segment that the tax laws, most of them were going to sunset, these though will not be expiring in 2025. These laws are they are permanent. Or at least that's the way they're set up on the business side. And Barry also has a few items that he would like to explain.
Yeah, well, some of the benefits that made the most press were the tax rates. Was what Kathy said, the corporate tax rate and the 20% deduction. Also, a very taxpayer-favorable benefit is that businesses are allowed to immediately write off almost the full cost of equipment in the year they place it in service. There's something called Section 179 that business owners might be familiar with. The limit on 179 is now $1 million. A business can spend up to $1 million on new equipment and expense it all in the first year. Also, if you don't take 179, there's a term called bonus depreciation. Old law was 50%. You could buy computers, equipment, whatever for your business and deduct 50%. The new law is 100%. And there is no, unlike 179, there is no limit. The old law for bonus depreciation was only applicable to new equipment. This is now for new and used. So I think a lot of taxpayers are going to find, businesses are going to find quick write-offs to be very favorable. The downside to that a little bit is Maryland does not follow these same rules, so you'll have to track Maryland fixed assets and federal fixed assets because there'll be an add back for Maryland in that first year, but then you'll have subsequent deductions in Maryland. Another one also going with depreciation is the auto limits, what we call a luxury auto depreciation. It doesn't really have to be a luxury automobile. It's really generally for business owners who own their vehicle, who use it over the weekends or at home at night for personal purposes, and also use it for work. The deductions have now increased significantly. In the first year, you can take $10,000 depreciation. It used to be about $5,000. In the second year, it's up to $19,000. So you can pretty quickly write off a work vehicle that you also use for personal purposes. So that's very favorable to usually the owners. Now, all these benefits come at a cost. So in some places they had to find money to then offset the revenue that's not coming in. One of the big deductions that's no longer allowed is called net operating losses. And I misspoke when I said not allowed. It's being curtailed somewhat. Normally, if a business, it's what it sounds like. Your business operates at a loss. Maybe you've taken all these extra bonus depreciation deductions I've just discussed. So you have a loss. The old rules, you can carry it back for 2 years and carry it forward for 20 years. And you were able to offset 100% of your taxable income in a prior year or a future year with these losses. Now, you can no longer go backwards. It could only go forward. and you can only offset 80% of your income. So it's a little bit of a limit, but then they've also let you carry it forward forever because they're curtailing it somewhat. So it's really just using losses a little slower. Another item that they've changed is what's called 1031 exchanges, like-kind exchanges. Again, there was some talk that was going to be eliminated completely. It generally applied to all property. As long as you exchange what they call in tax world like-kind for like-kind, you're allowed to do an exchange. What they've eliminated is for everything but real estate. If you're in the real estate industry, you can still do a like-kind exchange, but if you're not using real estate, you cannot do a like-kind exchange.
Looks like we have just about a minute left. Kathy, again, on the business side, are there action items you think would be recommended?
On the business side, I think some of the action items is don't rush to change. Don't be the flavor of the month, as I say. So I think that you should, use caution. I think that, as I mentioned before, the 21%, that's very favorable, but that's for the C Corp. Don't rush to change, your organization just to get the 21%. There may be other reasons why you're a certain organization entity already, and you want to discuss it with your trusted advisors team. And I think to hold off, on rushing to any particular change.
Very good. Interesting stuff. Thank you both for appearing. We appreciate it very much. How can we find you online?
You can find us online at our website, which is www.bormel-grice.com.
Thank you very much.
Thank you.
All right, we're going to take a break. You're watching Your Future, Your Finances. I'm your host, Brian Kuhn. We'll be right back.
The IRS is calling me? Is this for real?
Fraud is real. Hang up on fraud. Americans have lost more than $23 million by giving out information and money to criminals impersonating the Internal Revenue Service. Scammers are aggressive when they contact a potential victim and claim to be from the IRS. They often use a fake telephone number with a U.S. area code. They demand immediate payment. They may even threaten police arrest or deportation. Don't believe them. Instead, just hang up. Don't provide any information to these crooks. The real IRS will generally first make contact by letter and will never demand immediate payment or threaten force. If you suspect you've been contacted by an IRS scammer, submit an incident report with the Treasury Inspector General for Tax Administration at www.tigda.gov. Call the TIGDA hotline at 1-800-366-4484. Please share this message.
Welcome back to Your Future, Your Finances. I'm your host, Brian Kuhn. Here again, we interview a variety of experts on topics of personal finance, personal growth, and current events here in Maryland and nationally. Josh Kurtz, who is the co-founder and editor of MarylandMatters.org, a nonpartisan and nonprofit site that tracks the political and government news specific here to the state of Maryland, is my guest. Josh has been covering legislative and other important events coming out of Annapolis since 1995. Welcome to the show.
Thanks for inviting me on, Brian.
So we just finished up a legislative session here in Maryland.
Yeah.
What are some of the highlights that came out of that?
Well, I think the biggest takeaway is that they accomplished a fair amount, and that's pretty uncommon in the last year of a four-year term, because usually people are kind of focused on the elections. They don't want, sort of meaty and controversial stuff coming out. But this was probably the most productive last year of a session that I can really remember.
Paid sick leave is one of the topics that I heard about as that they passed.
Right.
What was the legislation there?
Well, the legislation actually passed in 2017, and the governor had vetoed it. And so this year, on the first or second day of the session, the legislature came back and overrode the governor's veto. So, that law is now in effect. And so really any business with 15 employees or more now have to, allow their workers to accumulate paid sick time. The governor had his own alternative proposal that he tried to get jump-started. There was some discussion about maybe delaying implementation of the law, but eventually that kind of fell by the wayside, and so now it's the law of the land in Maryland.
Interesting.
Yeah.
Other legislation that passed, perhaps related to health care, how people
Yeah.
secure health care?
Yeah, well, as your viewers probably know, that when the federal government passed its tax reform plan a few months ago, it took away the individual mandate out of Obamacare, out of the Affordable Care Act. And so they worked in Maryland to kind of address that, at least temporarily. And there was a very bipartisan push for what they called a reinsurance plan, and it kind of creates a pool of money that will enable insurance companies to recover money if the cost of a medical procedure, say, or medical care exceeds what they usually get reimbursed for. This is only a one-year fix. It's going to involve, some higher taxes, some probably higher premiums among the insurance companies. There are a bunch of proposals on the table for a kind of more permanent fix, a kind of way to keep the individual mandate going in Maryland, but they, at least on a very bipartisan way, kind of came up with this temporary solution. So basically Obamacare is secured for a year.
Okay, good.
Yeah.
Now, there's also a bill, as I understand it, that offers free community college now
Right.
in Maryland. Is that correct?
Yes,
Subject to some limits, probably.
Yeah, just signed into law. There are several kind of triggers to get it, but basically it's going to be accessible to just about anybody who comes out of high school with a 2.3 grade point average and goes to community college. There are some, it's basically, I think they call it a last dollar program. So basically, if you're getting other scholarships, if you're eligible for those, you should take those first. If you're, yeah, basically. So, but it will cover, after you get some other scholarships, it will cover everything. It's been done on a kind of pilot basis in 3 smaller rural counties already for the past few years in Maryland, but it's going to become statewide beginning in 2019.
Great.
Yeah.
Okay, good. The minimum wage, that's always a political topic, right?
Right.
Did they make any progress or concessions on how that's going to work?
No, in fact, there was a big push to get a $15 an hour minimum wage enacted in Maryland. Certainly, sort of the liberal Democrats were pushing hard for that. Some labor groups and progressive groups, but they it basically didn't get out of either the House or Senate this time around. But I expect that debate will be back next year.
Yeah.
Yeah.
Now, we're filming in May here, so the
Right.
legislative session is over, and I guess the midterms are picking up.
Yeah.
These are the Maryland-specific midterms.
Right.
What's the latest there?
Well, I mean, there's a ton of competitive races, particularly in the primaries. All over Prince George's, all over the region, all over the state. The big one is obviously who's going to be the Democratic candidate for governor, and I mean they're
Wide open.
Bunch of candidates. It's wide open, and they're just sort of fascinating primaries up and down the ballot, enough to keep the political junkies active. There'll be a smaller number of competitive races in the fall. The gubernatorial race will be one. There'll be like Baltimore County Executive, Howard County Executive will be competitive into the general election. But yeah, it's this is the big election year in Maryland. This is what all the politicians get excited about.
In Maryland, but also in D.C., there's Metro funding that seems
Right.
to be getting a lot of news. What's the latest on that?
Well, Maryland, Virginia, and D.C. all passed legislation this year to create more dedicated funding for Maryland for Metro. In Maryland, they agreed on $167 million of new dedicated funding for Metro. If you combine the 3 jurisdictions, I think it's about $500 million collectively. And this is really supposed to go to sort of capital improvements and repairs and things of that sort. Obviously, the Metro system has been pretty, it's gone through a period of decline, and part of the reason has been, there isn't sort of one agency or one jurisdiction that oversees it, and there's never really been a dedicated fund for it. The Metro systems had to scrap for money every single year, so this gives them some funding certainty. It kind of distributes the money evenly among the 3 jurisdictions. I think they're still looking for a big federal commitment, which isn't there yet. But I mean, it's a great start, and I think, with luck, we'll actually see some service improvements and enhancements going forward.
500 million, you would think they could make some progress with that.
One would hope, yeah, absolutely.
Another topic that's at the state level, more so than the federal level, seems to be medical or legalization of marijuana. Is
Right.
Maryland passing anything on that?
Well, we still don't have legal recreational marijuana. We now have medical marijuana is legalized, and the big fight in the legislature this year was over sort of who gets the licenses. A couple of years ago, they initially handed out 15 licenses for distributors. The Legislative Black Caucus was very upset because none was a minority business, and so they've tweaked the language in this session to allow 20 additional licenses for distribution and production and stuff like that. And so I think that's going to kind of distribute the spoils more evenly. But yeah, I mean, at this point, if you have a doctor's note, there are distributors around the state that you can now walk into and get legal cannabis. So, and I have to believe that, legal recreational marijuana is coming not too far down the line. I think the states that have done it are really collecting a lot of revenue, and nobody's going to want to miss out at some point.
Nobody's going to want to miss out on,
Right.
on the tax revenue.
Right.
Well, this is great. Appreciate you appearing on the show. How can we find you online?
We're at marylandmatters.org. We usually, people can sign up for a free email every day. We have about 5,000 emails we send out every day. We put new stuff on the site during the course of the day, but there's always fresh stuff, early in the morning at any rate. So please check us out, marylandmatters.org.
Thank you very much.
Yeah,
My
thanks
guest
for
has
having me
been
on.
Josh Kurtz of marylandmatters.org. We've run out of time for this episode. We thank you for watching Your Future, Your Finances, and I hope you have some takeaways. I'm your host, Brian Kuhn, and if you have any questions for the show or would like to contact me or any of the guests, you may email me at bkuhn@psgclarity.com. Lastly, as always, a thank you to Laurel TV for their production and airing of the show on Comcast Channel 76 and 996 for HD, and Verizon Channel 12 on the live stream at Laurel TV. See you next time.